Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again David McAlvany. He is the president of the McAlvany Financial Companies, McAlvany Wealth Management, and ICA. That's a 36-year-old precious metals brokerage firm. And I would strongly suggest that you avail yourself to some of the really interesting and important commentary that is available on a weekly basis that David provides. You go to McAlvany.com and you can click through to the weekly commentary or learn a lot of things, a lot more of the services that are provided by David. And I've known the McAlvany name going way back. I knew his father, spoke to him a few times. And so it was really great to have young David coming on the scene. And David, thanks so much for joining me again.
Great to be back with you. I'll just spell that last name real quick. McAlvany.com is the best place. But great to be back with you, Jay.
Yeah, great. Thanks for clarifying that. Yeah, it's a wonderful service, and again, I just listened to your commentary last week. You just came back from Europe, and understand that you took your 7-year-old son over to Europe with you, and it seems as though, David, you're sort of grooming him for the business too sometime in the future, possibly, if he's led to go in that direction, I guess.
And the values that we hold dear are the values that we convey on a consistent and routine basis with our families, day in and day out. And, I learned to travel and learned to think broadly from my father decades ago. I started traveling with him when I was 3. And so to have my 7-year-old son along for the ride through Paris and Hamburg and in Brussels as we're doing business and sitting through business meetings, and even making its way into certain depositories to look at thousands of gold coins. It's taking theory and bringing some practical experience to what we view as an education process.
Yeah, and it's great that your son can go with you. I think it's most important that the kids see that you're doing what you're saying. And anyway, you just came back from Europe, and you had some very interesting comments about what you discovered there. And I would suggest, rather than take our time, people should go to McAlvany.com to listen to all of those comments, because it is a 1-hour show after all. A lot of depth, and it's just a lot of interesting things. I couldn't stop listening. But I want to ask you today, David, on following this much ballyhooed interest rate increase of 0.25%. I'd turned on Bloomberg. I think it was the day following. The stock market responded positively, and it went up, and the next day it went up. And I think it was Wednesday morning, perhaps, when Larry Fink was on Bloomberg. He heads up the multi-trillion-dollar BlackRock hedge fund. He was praising Janet Yellen for her brilliance. He said, it's just Goldilocks kind of talk, not too hot, not too cold, just right, he proclaimed. And now the stock market has turned south since then a little bit. Mr. Fink's remarks, perhaps he wouldn't quite frame them the same way, I don't know. But how would you have responded to his proclamation of omniscience on the part of Janet Yellen? How would you respond to that, David?
Well, the interesting thing is, just by Friday this week, so late yesterday, early this morning, Larry Fink sends out this tweet: the U.S. economy is decelerating. And yeah, I think everybody wants to kind of suck up to the policymakers, but the reality is, Fink's got a large problem with his hedge funds. They're underperforming massively. And I think, like any smart and engaged person at this point, you realize that there is a difference between the financial economy and the rest of the economy. And there are segments within the real economy, not just the financial economy, which are already in recession. And so, for him to clearly state the U.S. economy is decelerating, well, of course it is. We're already in an industrial recession. And again, there are pockets where that's, I think, going to become more of a consistent theme as we head into 2016.
Yeah, so you figure we're in a recession possibly this year, the entire economy?
We may very well have entered into a recession 4 months ago. I mean, the National Bureau of Economic Research, of course, they'll tell us when officially we are, and they always look back. They don't pick a point in time and say, as of today. They'll say, oh, well, yeah, it has been 90 days, or it has been 120 days, or what have you. And industrial production numbers have been awful. I mean, we haven't seen these kinds of industrial production numbers outside of recession ever. So the idea that we, and again, maybe this is just an industrial recession, but I'm sorry, it's still a pretty decent part of our economy. And yeah, I think we have some indicators that we're already in recession.
So why do you think the Fed's raising rates now? I mean, do you think they really believe the propaganda that they're giving us, that the economy is healing and therefore it's strong enough to withstand? In fact, it needs to have a rate rise. Why do you think? Could you speculate a little bit on what you believe the motives of the Fed might have been to raise rates in what is clearly, at least the way you and I see it, and a lot of other my guests see it, a weakening economy? Why do you think they chose now?
I don't think they wanted to raise rates. I think they had to raise rates because at this point the credibility factor is very much on the line. Having skipped said move in September, it was absolutely necessary to do something. The 25 basis points is a fairly insignificant number. What the market is going to look at is the next several moves to confirm whether there is a directional shift. And if there is no long-term directional shift, then it was a one-off event, and they were just kind of following through on what they had promised. I would suspect that sometime in 2016 we not only go back to zero, but we go negative. And there's certainly been discussion amongst 3 or 4 of the Fed chiefs, as well as Janet Yellen, that the negative rate territory is certainly theoretically possible, and they're open to that if the circumstances require it. I think 2016 is going to require it.
Negative rates. It's just so perverse. It seems so perverse. You know, one thing I wondered, David, you mentioned the credibility factor. I'm wondering if possibly with the Chinese currency becoming more prominent, clearly the Russians and the Chinese stepping outside of or looking to compete with what I would say the petrodollar, setting up their own trading systems, their own banking system, putting in the institutions and the mechanics to do that. I read recently where the Russians are importing huge amounts of gold from the Chinese in exchange for oil sales to the Chinese, thereby certainly stepping outside of the petrodollar system. And I'm also hearing that the Chinese are reducing their Treasury holdings. I don't know if that jives with your understanding or not. But if the Russians and the Chinese are stepping away from Treasuries, which you could understand they might do given the geopolitical issues, do you think that one factor might be the need to make the dollar more attractive by raising rates?
Yeah, I think certainly that could be a part of the story is on a relative basis, we are more attractive. You look at the 10-year Treasury, and we're far more impressive than Spanish paper, Italian paper, most of anything in Europe. And at this point, there is some concern about emerging market debt. So, we do look very good, and in a rising interest rate environment, become even more compelling as a place to park money. The issue of petrodollar status, we're undermining that ourselves to some degree with the amount of oil that we're producing at present. That doesn't mean that we'll stay that way. We don't know how long we'll be able to pump at 9.3 million barrels per day, but that's up considerably from the 5 million barrels that we were producing in 2008. And it just means that we're importing less, and as we're importing less oil, it also means that there's less treasuries that are being purchased by our petro trade partners. Mm-hmm. So that's a reality is that we're sort of cutting off our nose to spite our face in that respect. The Chinese and the Russians know great love for us long term. You see a lot more compatible in terms of not only worldview but sort of command and control dynamics in both of those places. And yes, they are hungry for, as I think the rest of the world is, a less dollar-centric and less U.S. foreign policy-centric globe. So we're seeing gradual shifts. I don't know that that's going to be the centerpiece in 2016 and 2017 in terms of riling the markets. I tend to think it's going to be issues like market liquidity, where we discover that $38 trillion in assets that are in open-ended products, where clients who believe they have instant liquidity may in fact find they don't. $1.2 trillion in emerging market debt is in open-ended funds here in the U.S. And again, it's just this notion that I can always click my mouse and liquidate any quantity of assets that I want and move to cash. That's presumptive, and that may be true in normal times, but I think we're stepping into fairly abnormal markets where the surprise might be there's no bid and no one offering to buy the asset that you're offering to sell.
Well, we're certainly seeing some illiquidity in the junk bond market, aren't we?
We are, and I think that's already spreading into commercial paper and corporate bonds. So it's not just the far reaches of credit quality, but we're watching corporate cash flows diminish, and that means that their ability to service a much larger base of debt is going to be challenged in the next year or two. So I would guess that by the third quarter of next year, we're seeing major stress and strain, and maybe even a repeat of some of the sort of liquidity crisis type events that we had circa 2007, 2008.
Oh, we can hope not, but in any event, certainly the big corporations have been they've been borrowing a lot of money at these very cheap, low interest rates, and then going out and buying their stocks. And that's, I think it was Goldman Sachs. Somebody at Goldman Sachs last week was talking about how they expect that to continue into 2016, should provide more fuel for ever-rising stock prices. But I have to wonder, with the rising interest rates and reports that some of the most creditworthy companies, their balance sheets are becoming much more leveraged. Do you think this can go on much longer, David, at this part of the stock market that can keep it rising?
No, I think debt to EBITDA numbers are not pretty already, and so if you want to increase debt, I think that's going to be a pretty significant problem. I would have to disagree with Goldman on that, because you already have falling profits, declining sales, and you're already, I think 2015 got you to the edge of what you can do in terms of financial engineering. And it's, it's funny. We started the year 2015 with very few people realizing how many games had been played in terms of share buybacks in order to improve earnings per share reports. But by the end of this year, everyone pretty well knows. I mean, it's almost on a weekly basis. I'll hear, a Bloomberg or a CNBC say something about this perverse behavior and how, it's helped, but it can't go on forever. And I think everyone's fairly aware. It's just, Jay, to me, there's things that you can do when people aren't looking. As long as you're operating in the dark, there's things that you can do to some effect. But when those activities are brought into the light, now everyone understands that there's a certain corrupted nature to your earnings per share figures. When corporations get to the fourth quarter and say, hey, hoorah, we did it again, we beat expectations. Yeah. Now there's this growing consensus of investors who say, that's a bunch of garbage. We know how you got there. We didn't last year, but now we are appraised, and we're going to have to judge you accordingly.
Mm-hmm. Yeah, and that's healthy for the long term. Of course, it's painful in the process for people who are caught in the middle of it. But I have wondered, David, with the massive amount of quantitative easing that's gone on, not just from the Federal Reserve, but from from the Bank of Japan, the Chinese, the Europeans, everybody's printing money, creating money out of nothing, throwing it into the banking, into their respective banking systems, and yet, a lot of people would have predicted we would have massively higher prices. Now we've seen, of course, as you pointed out, the financial markets have bubbled up for sure. But we're seeing really quite substantial declines in commodities and prices of items that are directly related to the real economy. But why do you think that we're not seeing the real economy benefit, or we're not seeing growth in the real economy as a result of this massive amount of money creation?
Well, I mean, part of it is because you have not impacted wages. So, you are not seeing the man in the street empowered with greater income. And the average guy or gal in the street doesn't have a huge balance sheet that's getting a boost. So, as money's been created, this goes back to John Law and one of the people who were originally a part of the scandal back then, Richard Cantillon, and what has been described as the Cantillon effect, where you have, the smart people understand it first. They understand the nature of inflation. They understand the nature of money printing, and they start scrambling to protect. And you're already seeing what you would view as high levels of inflation anticipated by really smart money. What do I mean by that? Let me give you one example. It's very common for people to buy art. I understand that. I mean, particularly if you're in the 1% or tenth of 1% of very wealthy people around the world. But you know something's not quite right in the art market when you're paying 10, 20, 30, 40, $50 million for the work of a living artist who's still producing. You don't know how finite the supply is. You still don't know how they'll be judged by time. And yet that's what you're seeing is an exaggeration in value in places where most art collectors would tell you, you got to wait until the guy or gal's dead before you can really know if it's a collection that you want to build upon. So I think the wealthy are getting it. They're moving into very, whether it's art or, high-end apartments in Manhattan, these are the places that have been inflated the most. The man on the street, no, you don't get any benefit from the money that's been printed because it's boosted asset prices, surely. But again, looking at the average net worth of Americans, let's call it somewhere between $150,000 and $250,000. There's not much to get boosted relative to the 1% who might have 10, 20, 30, 50, $100 million. And yes, most of it's in assets that have doubled in price in the last several years.
Your outlook for the equity market then going forward in 2016 and the debt markets, I gather, are not terribly optimistic.
Very bleak would be how I would describe it. And again, I think we've gotten past peak profits. I think we've gotten past the earnings games and the financial engineering. Take IBM as an example. They've done their best. These are the guys that when it comes to financial engineering, nobody does it better. I mean, they're the kinds of games that they have played from an accounting perspective are absolutely genius. And yet they've run out of rabbits to pull out of the hat. And you're seeing that show up in their results. So I think the financial engineering games are at an end. And unless we see a considerable rebound in the real world economy, the financial economy is on the brink.
So you're from the top, let's say from the consumers up. I mean, we're not seeing consumers. The top line growth is not there, and that has not been there throughout this so-called recovery for the most part, right? And it seems to me that the consumers, we pushed them to the breaking point pretty much with the housing bubble. The ATM, using houses as ATM machines, and people have gone to pretty much the limit. Is the consumer paying down some debt? Is there some room there for him to start spending again, or do you think this is a long-term decline in the consumer's strength? I mean, we're seeing a middle class that's sort of being hollowed out, fewer and fewer, more and more people on food stamps. It just does look kind of bleak from that end. So, it seems to me that if the Keynesians, if we're really practicing Keynesian economics, they would have put money in the hands of the masses instead of the bankers, and then you could have some from bottoms up. I mean, in theory, not that I'm in favor of it, but do you think the consumer, because it seems to me that we need to see consumers come back and be healthy in order to see a broad-based economic growth. Would you agree with that? And do you think that's possible?
I would, and I think it is possible, but probably more on a 2017, 2018 time frame, and it assumes that oil prices stay low through the duration of that time. Because, look, $2 or less per gallon, it does translate into an energy dividend for the average family across America. The reality is we haven't seen it impact retail sales considerably in 2015. I think that's in part due to what you said. I think we're seeing deleveraging. We're seeing the average family say, I probably ought to get caught up a little bit on my credit card payments, pay a little bit more than the minimum. And so we're not seeing extra economic activity. They're playing catch up. And I think it'll take them several years to sort of clear the decks and feel more confident and comfortable that they're not facing a pink slip and can actually maybe add to the debt side of their balance sheet again, or spend from, more ideally, what would be savings accumulating.
Yeah, and you mentioned.
I think there's one other thing. You mentioned that this has been to the benefit of banks, Wall Street firms, and not necessarily the man on the street. Further evidence of that is this week's move by the Fed to increase the interest paid on excess reserves of depository institutions. We went from 25 basis points to 50 basis points, and this, in my mind, is absolutely asinine. If you want to see money come out of the banks and get lent to small businesses, then take away the carrot, which is keeping deposits there, risk-free deposits at the Fed. Take that number to zero, or in fact charge institutions for overnight money at the Fed. Instead, they raise it to 50 basis points. I mean, this is patently absurd.
Yeah.
It suggests to me that the interest is not really in the real-world economy. The interest of the central bank never has been. What that signals to me, more than anything else, is that the central bank is taking care of their own, a network of bankers, and that's all that matters to them is the financial economy. That will ultimately come back to haunt them, because an economy never will be sheerly or simply a financial entity. There's more to it than that.
Sure. No, I wasn't aware of that, and that is, I'm glad you pointed that out. That just seems so clear that the Fed is taking care of its own. I guess we shouldn't be shocked by that. But, David, the fact that isn't being pointed out in the mainstream media, I think, shows that the media is basically in cahoots with the establishment, obviously, which is, I guess, also not a surprise.
This is one of the realities, is that what the decision that happened this week, it was not really the decision that moves the interest rate curve. Stanley Fischer and the folks who are deciding what the interest payments are on excess reserves, they are the ones who are going to move the yield curve. And so, I think Wall Street and the guys in the credit markets who understand that are far more concerned about the interest paid on excess reserves than they are, an insignificant 25 basis point bump, because that's not enough to move the yield curve considerably. We live in very, very interesting times, and I think people are wise to not necessarily make their investment decisions on the basis of a recent headline.
Oh, that's for sure. Well, David, given your sort of bleak outlook, what are you telling your clients these days to do as we enter this new year?
There's three things clearly that you have to do. One is raise cash. Two is make sure that you have enough ounces of the physical metal to make a difference when push comes to shove. And three, every opportunity that you get to find an asset class that provides healthy income, take advantage of it. And by healthy income, I mean two things. One, healthy in terms of the total scale, but two, if you're going to see 5, 6, 7, 8, 9, 10% returns in terms of cash flow, look for high quality as well. Now, that may seem like it's an impossibility, but I think it can be done, just not inside the publicly traded markets. If you can find real estate that gives you an 8 to 12% yield, this is a place where you need to be buying not only a real asset, but something that gives you some cash flow. Cash flow. That has to be a priority moving forward, whether it's 2016, 17, 18, up to 20. I think by the time we get to 2020, if you haven't organized your cash flows, you're going to be in a world of hurt. So those three things, cash flow that you can control, cash that you have some of it outside of the banking system, and then the best denomination of cash also in your physical possession, right. which I consider ounces of gold and silver. I think these things are going to serve you very, very well. It's been 9 years since we've been anywhere in the mode of normalizing interest rates, and all asset classes have become addicted to this cheap credit. I'd hate to think what the consequences are as we begin, or if we begin to normalize. I've got to believe that it's horrendous, not only in the stock and bond market, but maybe in the real estate market as well.
Well, and that's why you need to be outside of the banking system, though. Cash outside of the banking system, as you say, and ounces of gold and silver outside of the banking system, obviously. Good advice for sure. And in terms of some of these ideas of where you might get healthy cash flow, I suppose those are some of the ideas that you pass along to your clients from time to time?
Well, sure. Yeah, no, there's no doubt about that. And I think probably the most frustrating issue in the midst of that is, and I was on a board for a college, and still am on that board for their investment committee. Mm-hmm. And this last week, I had to beat them down from investing in junk bonds. They're like, well, we need the yield. And I said, you can't do this. They're going to put $1.5 million into bonds, high-yield bonds, and they want to get rid of all of their gold. They want to, I mean, it's all of the wrong things at the wrong time. And you know what I find? I find that the thing that mitigates against investor success is having enough patience.
Yes.
Having enough patience. Things don't happen on our time frames, unfortunately, and when we need them to. But that's okay. I mean, just if you've found the right things to be invested in, practice patience, and I think you will be duly rewarded in good time.
Well, that's a really good advice, David. Thank you so much for being with us. And again, folks, go to McAlvany, McAlvany.com. Catch up with David's weekly broadcast. It is just chock full of great information and guidance. So thank you so much, David, for being with us, and look forward to doing it again sometime in the not-distant future. And a Merry Christmas and Happy New Year to you and your family and all your friends. All the best to you.
Thank you, Jake. Great to be back with you again.
Thank you.